All right, I think everybody's in. So good afternoon. Thank you for joining us. Tom Gramigna, who we have here from the Warner Companies, will examine how you can address and support the financial wellness of your employees across their many stages of their work life. If you have a question, please submit it in the chat. And if we don't get to it today, we will make sure one of our experts follows up with you. Credits is another big question that we get. So your SHRM and your HRCI credits will be awarded via email for those of you who are eligible, meaning you're staying on for the entire webinar. And the recording will be available on demand within the next day or two on our website. So Tom, let's do some financial planning.
All right. Thank you, Dina. Good afternoon, everyone, and hope everybody's having a good summer and your air conditioning is working better than mine at the moment. So hopefully summer is going well. Dina, thank you for setting this up, and I appreciate Corporate Synergies as well as our host. There'll be a question and answer session at the end. Obviously, you'll submit your questions, and hopefully, I'll try to answer as many as I can as we go. Again, my name's Tom Gramigna. I'm Senior Vice President at the Warner Companies. I'm a registered investment advisor, and I act as an independent fiduciary for my investment in 401k clients. We act as a 321 and a 338 fiduciary for our clients. Um, Financial wellness. The importance of financial wellness in the workplace. 77% of workers want their employers to focus on providing benefits central to their financial well-being. More than half of the workers spend time every day worrying about their finances during the workday. And 1/3 of American workers say that the financial stress is impacting their job performance. So financial wellness in the workplace is clearly a very, very big issue. What are some new offerings that companies are using to promote financial wellness in the workplace? And you could pick which ones resonate with you, but student debt assistance is a big one at 31%. Retirement planning at 56%. Coaching, education is the most popular at 84%. Utilization of digital financial tools online at 70%. And then lastly, either adding a 401k match or potentially increasing the current match that you already have, sort of rounding up the end there. Our topics that we're going to cover today, student loan debt and the crisis that is just around the corner and happening as we speak. Household budgeting. Many of you folks may be on the phone. Certainly, a lot of your employees have difficulty budgeting. So that's another, hot topic with your employees, just because, again, a lot of people in today's world are certainly spending more than they are making, and that is unsustainable. Third is risk management, covering both life and disability insurance, which is an employee's ability to earn income is probably their most important asset. And if that isn't protected properly, the whole financial planning for the family goes down the tubes. Number four, Secure Act 2.0 and changes to retirement plans that they've enacted. Some of you are probably up to speed with most of this, and some of you maybe will learn some new things today. And then lastly, providing funding for college through 529 plans. Please remember the Secure Act 2.0 offers many new policies and strategies to tackle almost all the topics we're going to address today. However, it's a very fluid environment, and companies are still looking for direction and clarification on many issues. So a lot of the 2.0 things are going to be subject to change and/or are going to need some more clarification as we go through these. Starting with the first the first is managing student loan debt. The student loan debt problem in the United States has reached crisis levels and is having far-reaching negative impacts. The debt levels are actually staggering when you look at them. The total outstanding student loan debt in the United States has surpassed $1.7 trillion. That exceeds both auto loans and credit card debt. The only debt that is higher in the United States is mortgage debt. So that goes to show you the level of college debt that's out there and how important it is to your employees and your staff. 43 million Americans collectively owe 1.6 trillion just in federal student loans alone. That doesn't account for other type loans, private loans, etc. And the average student loan debt for recent graduates is about $30,000, but many owe significantly more, especially those with graduate degrees. So this is a really hot topic with in the country with most of your employees, and the issues that they're dealing with. Managing student um, managing this debt is causing all kinds of issues. First of all, delaying life's milestones. Many borrowers are delaying major life decisions like buying a home, getting married, or starting a family due to these student debt obligations. This can have long-term impacts on both wealth accumulation and their overall financial security. If anybody can think back to COVID or pre-COVID, if any of their employees were thinking of purchasing a home at that point in time and decided not to because of whatever reason they couldn't afford to because of student debt and other obligations. Fast forward 4 years, they missed out on an incredible real estate boom that could have helped them with significant household equity in their home. So that's just one example of from a wealth accumulation or financial security that on how they've missed out. The economic drag continues for them. The high debt levels are limited borrowers' ability to participate fully in the economy through consumer spending and investing. This debt overhang acts as a drag on the economic growth and mobility of really an entire generation. A lot of analysts are predicting that this student loan debt, now that it's payable, again, through COVID, there was some, you didn't have to pay during COVID. And now that and plus people also got some free money. So now that that is over, there's concern that maybe this could be sort of the next shoe to drop and a recession to follow, because again, a lot of these people can't afford their monthly payments and be able to live with the rate of inflation as it is right now. Managing the student loan debt. Beginning in 2024, the Secure Act 2.0 allows employers to match employees' student loan payments with contributions to the retirement plan accounts. This allows workers to save for retirement while paying off their debt. Some of you may be aware of this and some may not. So basically how it works is an employee that currently, pick a number, is paying $6,000 towards their loan payments a year, and they're not part of your 401k plan now. What you are allowed to do if you decide to enact this would be to count that as if they deferred that into the 401k and therefore use that number to match their contributions into their 401k that they before weren't participating in. So again, it's a really interesting thing that the government's trying to give to employees and employers to help their population save for retirement, because again, they're maybe not able to save currently now because of the high debt. To address this need in your own workforce, a couple things you need to look at. First of all, assess the employee population. Employers should survey their workers to understand how many employees have student debt and how it impacts the 401k participation rates. So they may not be participating in the 401k because of this debt or because of other debt. But again, if you survey your employees to find out if it's a big impact, if it's worth going down this road to adding this as a benefit for your employees. You can review your existing 401k match structure. If the company already offers a 401k match, they need to decide whether to extend this existing match to include student loan payments. Determine eligibility requirements. Employers have flexibility in crafting eligibility rules in this plan, as long as it doesn't discriminate in favor of any highly compensated employees. 4, you're going to have to set up a verification process. They now have set up where employees can self-certify, but employers will need to establish a system to verify annually employee student loans payments have been made. And then lastly, adjust benefits budgets, as companies need to assess and potentially adjust their budgets if they're going to accommodate this new option, if it's going to cost extra funds for the company. Again, all this extra administrative burden You're going to have ADP testing. It affects ADP testing and obviously affects your budget. These are being put in though just as an attempt to attract and retain employees. Other individual strategies for attacking the student loan crisis. Number one, you can help your students and your employees enroll in an income-driven repayment plan. For federal student loans, income-driven repayment plans cap your monthly payments at a percentage of your discretionary income, typically 10 to 20% of your discretionary income, and extend the repayment period to 20 or 25 years. Any remaining balance may be forgiven after that period. This can provide significant relief if your income is low relative to your debt for any of your employees. Secondly, you can explore student loan forgiveness programs. Depending on the employment in the company that they work for, they may qualify for loan forgiveness programs like public service loan forgiveness, perhaps if you're a nonprofit, teacher loan forgiveness, perhaps if you're a charter school, or forgiveness for total and or permanent disability, or if your school is closed. Other debt strategies are refinancing student loans. Refinancing federal or private loans by combining them into a new private loan with a lower interest rate may be able to reduce your costs over time. However, you have to be careful because if you go to a private loan, you will now lose the federal loan benefits like income-driven plans that we just talked about. Consolidated federal loans. You can try to consolidate multiple federal loans into a single direct consolidation loan. They can simplify payments, potentially lower monthly costs by either extending the terms or lowering the rate. And by doing this, you'll still allows you to have access to the income-driven plans that we talked about earlier. And then lastly, your employees may want to seek temporary relief if they're struggling. Options like deferment or forbearance can temporarily pause payments, though the interest may still accrue. Popular budgeting strategies for your employees. Here are just three, but there's a ton of different budgeting strategies. But here are three that you can use with your employees. Again, lots of Americans today are spending more than they make, and it's unsustainable. So it's creating, additional debt, whether it be credit card debt, home equity loans, all kinds of private loans on top of the student loan debt that they currently have. So three of the more popular budgeting strategies that you may want to share with your employees is the first one is called the 50-20-30 budget. In a 50-20-30 budget, the first 50% of your net income goes to your needs. 20% of your net income, net take home, should go to savings. And then 30% goes to your wants. So sometimes this simplifies things for people and makes it a little bit easier. And you know that you're at least saving 20% every single month towards whatever goals it is. It might be an emergency fund. It might be to purchase a home. It might be for retirement, for college, for whatever. But again, at least 20% of their net take home in this example would be going towards savings. The second one is pay yourself first. In the pay yourself first method, you make it like a bill that you pay every single month to your savings account. So that's the first bill you pay every single month, and you transfer a predetermined amount into savings at the beginning of each month. After you pay yourself, you're free to pay the rest of your bills and use whatever's left over how you choose. But at least now you set that money aside again for future housing purchase or emergency fund retirement. You set it ahead of time and don't have to worry about, what balance is left in your checkbook. And then lastly is zero-based budgeting. In a zero-based budget, every single dollar of your income is assigned to an specific expense, leaving you with zero money at the end of the month. This method requires you to anticipate all of your upcoming expenses so that you have a lot of your income all set and expenses all accounted for. People sometimes will use Quicken and Mint for these type of programs. It can be a little cumbersome, but again, that's another way for people that really like to control or understand what they're spending every single month and where it goes. That's a strategy that does seem to help some people. Um, Part of good financial planning is emergency savings, having some emergency savings. Generally speaking, somebody should have minimum of 3 to 6 months of whatever their expenses are monthly, saved in checking, savings, saved somewhere in an account that's readily accessible, that's liquid, that they can use in case of an emergency. Most Americans do not. So if your bills are $5,000 a month, you should have at least $15,000 to $30,000 set aside. And that can be a daunting task. So because of that, beginning in 2024, the Secure Act 2.0 is allowing
Thank you for
employers
calling Mission Square Retirement Plan Sponsor Services.
to add
For your
emergency
protection,
savings
all
accounts
calls are
to their
recorded.
defined
If you are calling
contribution
for help with
plans
your account
for
login,
non-highly
first,
compensated employees. This encourages short-term savings alongside long-term retirement planning. It is a designated Roth account eligible to accept participant contributions for non-highly compensated employees starting in 2024. Contributions are limited to $2,500 annually, and the first 4 withdrawals in a year will be tax and penalty free. Depending on the plan rules, contributions may be eligible for an employer match. In addition to giving participant penalty-free access to funds, an emergency savings fund could encourage plan participants to save for short-term and unexpected expenses. Currently, these are implemented by your 401k plan provider and may be easiest to create them on a side-by-side plan instead of integrating them with your existing 401k. Secure Act 2.0. Again, Secure Act 2.0 has expanded several new penalty-free withdrawal options for 401k plans and other retirement plans. First of all, they added emergency expenses. It allows for penalty-free withdrawals of up to $1,000 per year for emergency expenses. The amount must be repaid before taking additional emergency distributions in the future, unless new contributions equal or exceed the withdrawal amount. Domestic abuse. Victims of domestic abuse can withdraw the lesser of $10,000 or 50% of their vested account balance. The distribution must be made within 1 year of the abuse incident. Terminal illness. The terminal illness clause eliminates the 10% early distribution penalty for withdrawals made by terminally ill individuals. Terminal illness is defined as a condition expected to result in death within 7 years. Number 4, disaster relief. Anybody that turns on the news or somebody that lives in Florida or Texas is dealing with all the flooding, or California and the wildfires that are going on, there's a lot of natural disasters happening in today's climate, in today's environment. The Disaster Relief Fund allows $22,000 in penalty-free withdrawals for expenses related to a federally declared disaster. These distributions must be taken within 180 days of the disaster occurring. Other existing exemptions, the Act builds upon previously established exceptions, such as those for unreimbursed medical expenses, first-time home purchases, and qualified higher education expenses. Risk management and life and disability insurance coverage for your employers. I included 2 pages in here that you can use with your employees. I assume many of you offer both group life and group disability to your employees, as well as potentially voluntary programs for both life and disability insurance. Again, an employee's ability to earn income is really their most important asset, and they really need to make sure that they insure it. And these two slides you could walk through with your employees to help them understand how to go about or why they need such a coverage. You would ask them to review their life coverage and consider increasing to protect based on their family's income, protect their family's income in case something happens to them. Look into adding disability insurance as well to replace your income if they were unable to work. Now, how do I figure out how much protection I need? There are a lot of formulas if you go online and look up how much life insurance or disability somebody would need. However, typically it comes down to the reason for the purchase in the first place. Two specific examples are if you're looking for income replacement and you have somebody that's 40 years old that wants to replace their income for, say, the next 25 years, they could add up their annual expenses, multiply it by the 25 years that they plan until retirement, and that gives them a rough number. Now, that's one way to do it. There are also, if you consider, you may want to make sure your loved ones have enough money for other things, such as weddings, to go to college, take over a business, buy a business, fulfill any other long-term goals or objectives. So that could be another thing as well. And they would have to put that into the calculation as well. After having a discussion, they need to decide how much insurance, and they decide that they need some life insurance or disability. They need to check to see how much they can afford. They don't want to be insurance poor, and they want to have all this insurance and then no money to be able to live. So just as with any other major purchase, it's important to make sure that your life insurance or your disability premiums fit within your budget. Remember, they need to remember that some life insurance premiums will increase over time. So it's really important to make sure not only can they afford them today, but they can afford them tomorrow. In finding the right policy, once you determine how much coverage you need, you can look whether they want to do term insurance would be best for your employee, or some form of permanent coverage like whole life or variable life that would build cash value. For most of your employees, term insurance will probably be the best answer for them. It will be typically it's very inexpensive, and they will not need the coverage forever. But everybody's insurance needs obviously are individual to each person. So, but again, term insurance is normally the way to go in these situations. Secure Act 2.0, getting back to Secure Act again. Secure Act 2.0 boost to retirement savings. Secure Act 2.0 introduces several key changes aimed at boosting anyone's retirement savings. First, automatic enrollment in the workplace retirement plans. Starting in next year, 2025, any new 401k or 401(b) plan will be required to automatically enroll eligible employees at a contribution rate of at least 3%. This aims to increase participation, especially among lower wage workers. Now, in reality, current plans do not have to enact this, but I have many plans that are considering have done auto enroll or are considering it. From a participation standpoint, there's no question that it will increase your participation. Just from those employees that just don't go online or don't understand it or whatever, and they just never get off the couch and sign up for the 401k plan. By auto enroll, that forces them in. Obviously, they can opt out later if they'd like. So from a participation standpoint, there's no question that auto enroll is awesome for retirement plan savings for employees. Utilization rate is a big question mark. And what utilization rate means is how aggressively your employee is saving for retirement in their 401k plan. So if you did an auto enroll at 3%, and that same employee would have signed up by himself at 10%, then maybe it didn't help that employee unless they go in and change that. So we don't really know how that shakes out, but that's some of the arguments against auto enroll. But from a participation standpoint, it definitely helps. The only other argument against auto enroll would be sort of what I call as the big brother complex, is some employees, and you know your population better than I, but some employees may complain that money was taken out of their paycheck without permission and then get all upset, even though they can opt out. Sometimes it leaves a stale taste in the employee's mouth. So that's the other negative. But again, from a participation standpoint, auto enroll is very, very good for the employee, and it seems like it's here to stay, especially with Secure Act 2.0. Additional things they're doing to increase retirement savings is higher catch-up contribution limits. Beginning in next year, again, 2025, individuals age 60 and 63 will be able to make catch-up contributions up to $10,000 or 50% more than the regular catch-up amount in their 401k plans. Again, they're looking at people that maybe are getting close to retirement, that haven't saved enough, that are really looking for that extra boost. And this is allowing them to get a little bit of an extra boost. Other things that have been done, increases for required minimum distributions, or RMDs. It used to be age 70 and a half is when you had to do what's called a required minimum distribution. If you had an IRA or 401k, you had to take out of that. The age now in 2023 was changed from 70 and a half to 73, and going further to age 75 in the year 2033. So basically, this is going to allow your retirement savings to grow tax-free for a longer period of time. The longer you can have your money grow tax-free without being forced to take out, the more money you'll have accumulate and have at the end. Roth account changes. Roth accounts in an employer-sponsored plan will be exempt from RMD requirements starting in 2024. Additionally, employers can now offer Roth matching contributions. These provisions collectively aim to make saving for retirement more accessible, more flexible, and more beneficial for workers across various groups and financial situations. Safe harbor 401k plans. Most of you probably all have 401k plans. I don't know if you have a traditional match or a safe harbor plan. Safe harbor plans automatically pass IRS non-discrimination tests, allowing the highly compensated employees to maximize their contributions. Employers must make mandatory contributions that are immediately vested. There's no vesting schedule. There are three main types of safe harbor contributions. The first one is non-elective safe harbor. Employers contribute 3% of salary for all eligible employees, regardless if they contributed to the plan or not. This type of election benefits lower income employees and maybe some of the people that are struggling with college student loans and are unable to participate in the plan. They still get the election whether they're part of the plan or not. So they get a match and have a 401k building for them, even if they never choose to participate with their own money. Basic safe harbor match, the employer matches 100% of the first 3% of an employee's contribution, and then 50% of the next 2%, again, of the employee's contribution. So to receive this, the employee has to be contributing to the plan. And then the third safe harbor is called an enhanced safe harbor match formula, that the employer matches 100% of the first 4% of employee contributions. Safe harbor plans are very popular among small businesses, with over a third utilizing that option today. Traditional employer matching plans, traditional 401k plans offer more flexibility in their matching formulas, but they must pass annual discrimination tests. Common matching formulas for a traditional 401k plan would be 50 cents on the dollar for the first 6% of pay, or dollar per dollar for the first 3%, plus 50% per dollar on the next 2% of pay. The average employer match currently in the United States is 4.5% of an employee's pay. Some plans also impose maximum dollar caps on employer contributions or vary the match based on factors like age, tenure, or something else. We often benchmark these type plans within your industry and even size company to give you an idea and make sure, are you competitive in the marketplace, too generous in the marketplace, or not generous enough? And again, the benchmarking will help you make decisions going forward on being able to attract and retain qualified employees. Choosing between a safe harbor and a traditional 401k plan. That can be a difficult decision. Typically, safe harbor plans are beneficial if the following things are happening. The plan is likely failing non-discrimination tests. People will often look to do a safe harbor plan if they're failing the non-discrimination test. Highly compensated employees are limited in their contributions. So they're getting corrective distributions, and a higher compensated employee is unable to take full advantage of the 401k laws and defer their $30,000+ into the plan if they're over age 50. Thirdly, a company already offers a match that is really close to the safe harbor. So it really, by changing to the safe harbor, won't hit their budget very much, and then alleviates them of all the non-discrimination tests and things like that, then that might make sense. And then lastly, smaller businesses, typically 25 or fewer employees, often look towards doing things like that. Traditional plans offer more flexibility, but require, again, annual testing that may limit contributions for highly compensated employees. The Secure Act allows employers to actually switch to a safe harbor 401k plan with a non-elective contribution up to 30 days before the plan year ends. So again, if you're considering something like this, it's not too late to make a change if you're looking to make a change. When deciding on a 401k plan structure and/or matching formula, employers need to consider a ton of factors such as budget, employee demographics, retention goals, and compliance requirements. One story I can tell you about that we recently picked up a client this spring that was really having trouble with failing these non-discrimination tests, and their highly compensated employees were getting corrective distributions and unable to defer in the plan significantly. They actually contacted us asking us, because we also do 403B plans, considering moving towards that. At the end of the day, we were able to, through auto enroll, increasing their auto enroll that they were already doing, just increasing it slightly, solve the non-discrimination tests. So now all their highly compensated employees in this situation, it was a healthcare system with about 1,100 employees, 300 which were doctors, and then a lot of other lower paid people. But now the doctors could fully contribute to their 401k plan, which helped them retain the current doctors and attract even more because their 401k plan is now working better. To help pay for this, their plan is with ADP. We were able to go back to ADP and significantly reduce expenses, both on the investment side and the record keeping side, to help pay for some of this, because obviously, as people in the HR world, you don't have unlimited budgets. So we're able to find some of the money to fund some of the things that they wanted to do. Employer-based funding for 529 plans. Employer-based 529 contributions are a new and innovative benefit that can help employees save for their children's education. Here are some aspects of implementing an employer-based 529 contribution program in your firm. First of all, understanding what a 529 plan is. 529 plan is a tax advantage savings plan designed to encourage savings for future education costs. It is named after Section 529 of the Internal Revenue Code. There are two types of 529 plans: prepaid tuition plans and education savings plans. Prepaid tuition plans are not nearly as popular, but they allow savers to purchase credits at participating universities and colleges for future tuition. Education savings plans, which are much more popular, allow savers to open an investment account to save for future qualified education expenses. When you open these plans, you can open any state and the person can go to college in any state. It does not matter if your plan is New Jersey and you go to college in another state, that is totally fine. What matters, which we'll talk about in a little bit, is how the taxes work. Employer contributions. Employers can make direct contributions to employees' 529 accounts as part of their benefit package. Matching contributions, similar to a 401k, employers can match employee contributions to their 529 plans up to a certain limit. And then incentives for participating. Employers can offer incentives such as bonuses, additional contributions for employers to participate in 529 savings plans. Tax advantages. First and foremost, why people do these is the federal tax advantage. Contributions to 529 plans grow tax-free, and the withdrawals for qualified education expenses, such as tuition, room and board, books, and a list of other things, are not subject to federal tax. So again, all the growth in these 529 plans is never subject to federal tax, which is significant savings. On top of that, each state may offer tax deductions and or credits for contributions to a 529 plan. So employers and employees should check their state-specific benefits. One thing that does, or question that does come up with 529 plans is how does it impact financial aid? And depending on the institution, it could have an impact, not quite as much as if it was in a UTMA account for the child or owned by the parents. But again, it can have an impact. But typically that is determined by each college or university. So they'd have to look into each college and university on how they're handling those issues. Benefits for employees. First of all, it's ease of savings. Let's face it, if you do automatic payroll deduct, it makes it really easy for the employee to contribute regularly, and it's before they get paid or right out of their payroll, so they don't have a chance to spend it. So that's really the benefit of this is ease. They honestly can do the same exact thing out of their savings account and open up a 529 on their own, but typically when it hits their checking account, they spend it. So sometimes this forced savings plan will help them. Secondly, financial security. It helps employees save for their children's education, reducing future financial stress. And then lastly, retention and recruitment. It's an attractive benefit that can help improve employee retention and recruitment efforts for your company. Implementation steps. First of all, plan selection. You need to choose a 529 plan that offers favorable terms and investment options. Again, some states have specific plans with additional benefits for the residents, so you have to look into that. And then secondly, you're going to have payroll integration. So you're going to have to work with your payroll provider for that as well. Employee wellness. How strong is your employee wellness? A comprehensive financial wellness program can significantly benefit employees and the organization. Here are key components of an effective financial wellness program. First, financial education and literacy. A lot of companies will set up workshops and seminars for their employees. They'll offer sessions on some of the things we discussed today, such as budgeting, savings, investing, retirement planning, debt management, and other financial topics. There are online courses and webinars that they provide access to digital tools, digital resources that employees can use at their convenience. Educational materials, distributing of brochures, articles, newsletters, covering various financial topics, whether ones we covered today or different ones. Some companies are offering personalized financial planning. So they're either doing financial counseling, providing access to certified financial planners for one-on-one sessions with some of my team or myself, retirement planning, offering tools and advice on 401k plans, IRAs, or other retirement savings options, debt management assistance, helping employees with strategies to manage and reduce debt, whether it be their credit card debt or the student loan debt that we talked about earlier, or some other personal debt that they may have. Savings and investment tools. Again, we spoke about automatic enrollment and contribution escalation. So automatically enrolling employees in retirement plans and increasing those contributions annually, again, can help with their financial wellness by forcing them to save. Employer matching contributions, again, offering matching contributions to enhance retirement savings. If you're not offering a match currently, maybe consider offering some sort of a match. If you are offering a match, maybe consider increasing that match. Emergency savings accounts, we talked about possibly setting those up. Facilitate the creation of those accounts for unexpected expenses for your employees. And then lastly, health and wellness integration, utilizing HSA accounts, combine financial and health wellness by offering HSAs and medical expenses for medical expenses. Again, there's a lot of top things that we touched on today. And a lot of these things can be helped or you can utilize your 401k record keeper for these. If your 401k record keeper is not helping you, let us know and we're happy to help you in any way that we can. Again, as far as finding ways to pay for some of these services, again, through the 401k by benchmarking it and renegotiating either with your current vendor, your current record keeper, and or going out to bid can really be very, very helpful. As I had indicated in that case of the company in California, they were able to get substantial savings that they used to provide other benefits for their employees. When I put together this presentation, I really wasn't sure of the audience and sort of what their population looked like. So there's certainly plenty of other financial planning tools and topics that we could have covered. For example, if you have an older population of employees, maybe issues like Medicare and how to deal with that. Long-term care insurance is a big topic for people 60 and older. And then lastly, Social Security. Should I take my Social Security early, at normal retirement age, or wait all the way to age 70? So again, that's topics we certainly could cover at a later date if you have an older population. Or most of this is geared towards your average rank and file, non-highly compensated employee. But if you're looking to do things for the highly compensated employee, we would open up discussions, whether it be deferred compensation, Roth lookalike plans, or potentially executive disability insurance that covers additional salary where your group plans do not cover. So I appreciate everyone's time today, and hopefully everybody was able to learn something today. Hopefully it looks like there's a few questions in the chat that I can try to answer. So Anna Ortega asked, hello, will you share these slides? Yes. So what we will do is at the end of after today, Dina Beck will be sending this in a PDF format along with anybody that's trying to get CE credits or what for them. So yes, they will be sent out to you.
Looks like that might be it, Tom.
Okay. So everyone, I appreciate your time. It didn't seem like there's a ton of questions, but Dina will send out my contact information along with this presentation, and feel free to contact me via phone or email, and I'll try to answer any questions that you all may have.